Welcome to yet another informative podcast on private equity, where we talk about everything you need to know about this market. Today's topic revolves around the most common mistakes made by private equity investors, which often lead to significant losses. Whether you are a seasoned veteran in the industry or just starting, these mistakes can affect anyone. Private equity investment is not as simple as it may seem, and the complexities involved can make or break an investment. So, what are the most common mistakes made by private equity investors? Let's discuss. The first and most obvious mistake is not doing enough due diligence before investing. Private equity investors need to investigate thoroughly before investing to understand the company's value and potential growth. This research can involve looking at the financial statements, reviewing the company's business plan, and conducting interviews with the management team. The second common mistake is unrealistic expectations. Some investors have unrealistic expectations about the return on investment and fail to give the investment enough time to mature. The high return on investment that private equity offers can lure investors into thinking it will happen quickly. However, this is not always the case, and investors need to have realistic expectations and be prepared to wait for the investment to bear fruit. Thirdly, some investors enter the market without fully understanding the potential risks involved. Private equity investment is high risk, high reward, and investors should be aware of the risks and have strategies in place to manage it. Inadequate risk management can cause substantial financial losses. A fourth mistake is poor investment structure. Investors should understand the investment structure before investing to avoid any potential legal or tax implications. Any investment structure should be thoroughly reviewed and developed by experts in the field. Another common mistake is a lack of diversification. Private equity investment can provide high returns, but these returns come with significant risk. Investors who put all their resources in one investment can suffer substantial losses if the investment fails. Diversification can help mitigate this risk by spreading their investment across several portfolios. Finally, not having a plan for exiting the investment is another common mistake. Investors need to have an upfront plan for exiting the investment, whether it is through a sale, merger, or IPO. A well-planned exit strategy ensures that investors get maximum returns on their investment. In conclusion, private equity investment can bring significant financial gains, but it is essential to avoid these common mistakes to avoid significant losses. Investors should conduct thorough research, manage expectations, understand risk, structure investments effectively, diversify portfolios, and plan exit strategies. We hope this podcast has been helpful in outlining the most common pitfalls in private equity investment. Stay tuned for more informative podcasts on private equity.